Hello, everyone, and welcome to the MakerDAO Scientific Governance and Risk Meeting, number 99, taking place on Thursday, July 2nd. I'm LongForWisdom, one of the MakerDAO governance facilitators, and I'm joined with a whole bunch of Maker people. Cool, so I'll go through the agenda in just a second, but I think the main event for today will be discussing the comp liquidity mining impacts. So I think we'll try and leave that too close to the end because I don't want to get it interrupted too badly. So we'll come to that in a bit. Let's just go through the rest of the agenda though. So first I'll be doing governance at a glance. I'll also be doing a brief MIPs update on behalf of Charles, our MIP editor, because he is currently unavailable today. I believe Nick has a brief update on the Oracle proposals, Nick being the Oracle domain team. And then we'll get to risk, and Cyrus and Vishesh can do that thing. Cool, so I'll briefly go through governance at a glance. Most of the discussion this week has been around comp, so I'll kind of leave that for Cyrus. I'll just briefly go over the other things. So yeah, multiple threads about the comp farming. One from Cyrus where he shared his concerns. One where Planet X suggested some poll options of like possibilities that we could do to, or the Maker could do to react to it. And I'd just like to highlight as well that the Vault compensation plan thread is still in the forum and can still use some feedback. So if anyone has some time, I would suggest reading that. We've only got one signal thread currently. Actually, it's just finished, actually, thinking about it. This was adjusting the WBTC debt ceiling and risk premium, which I actually haven't checked the result. Does anybody know offhand? Feel free to speak up.
I'll check it out and report back in a second.
Yeah, I'm checking it as well. I just thought. Okay, yeah. So that seems to have passed like 19,000 to 0. So fairly favourable pass. So I guess that'll be in the executive on Friday. Cool. So that about covers it for governance at a glance. As I said, most of the discussion has been focused around comp. So I'll just briefly go over Charles's stuff. Essentially, this week is kind of in between 2 monthly governance cycles for MIPs. So there's no like sort of MIP specific content today, nothing to do with the governance cycle anyway. But I'll just briefly go into what's come up. So I believe Charles has submitted MIP 16, which works towards codifying the weekly governance cycle. So that's now in RFC. And will probably be submitted, formally submitted for the July governance cycle, which starts, formal submission period for which starts next Monday until next Wednesday. So next week we'll be able to kind of tell everyone what's happening in July, hopefully. Right, I think that pretty much covers governance and MIPs. So Nick, do you want to do a brief update on the Oracle proposals?
Sure. So we had a bunch of Oracle proposals go through polling votes last month, right? So there were a bunch of whitelisting proposals from DeFi Saver. There was one from MCDEX, and there were a bunch of light feed proposals. So I think we had Infura, Gitcoin, Kyber, and Etherscan. So I've been assisting those teams with setting up their new feeds, and it looks like everyone's ready to go. So we'll be batching those into tomorrow's executive proposal for kind of final ratification from the community.
Cool.
And just FYI, we also got a proposal from Argent submitted today to become a light feed. So that's going to be something that we process in this next month of July.
We love Argent. I have a question for you, though, Nick. Is there an upper bound on light and dark feeds where it becomes less useful? Add more?
Yeah. So there's not an explicit boundary, but it's kind of just implied, right? Where I think I talked about this on a previous call, where kind of one of my little submissions was to balance the to reach an equilibrium kind of between this balance of power between dark feeds, right, these anonymous identity feeds, and light feeds, right, the public identity ones. And I think I've heard some people say that well, why do we even want an even number? Like, why don't we just go super hard on the light feed ones? But I think it's kind of a double-edged sword, right? You don't want the community to one day like turn against Maker and have the power to actually like completely screw it over if just based off of like sentiment, right? So in that sense, the dark feeds can be really useful. And the idea is basically that if you have sort of an equilibrium between dark and light, and you set the quorum higher than what any one kind of isolated group can attain, then it's kind of just overall makes the oracles much more secure. So that's kind of why we've been adding so many light feeds lately, and I think we'll kind of continue to add light feeds at like an accelerated pace until we kind of reach that equilibrium. But you're absolutely right that there are diminishing returns, right? Each of these fees gets paid every month, right? They get paid 1,000 DAI. That's currently at least, right? That's the parameter set by governance, right? We could always change that down the road, but it's a trade-off between added cost to the system versus what is the extra security of one more fee, right? There's marginal returns at some point.
That's interesting. All right, thanks.
Cool. Okay. I think then we've got Cyrus here, right? Yeah, cool. Cyrus, I think I'll turn it over to you, and it's up to you, I guess, if you want Vishesh to do state of the peg first, or if you want to go straight into the.
I think we should jump into the compound stuff first, because I think those. I think it'd be good to have that before we talk about the peg. Okay, so I think I'm going to just start off with kind of like a brief recap or overview of how I perceive comp farming and also how it's evolved over the past 2 or 3 weeks. And then if anybody, if anybody wants to jump in and correct me, more than happy to have that. Okay, so Compound launched their governance token maybe roughly 3 weeks ago now, and they had a very novel distribution mechanism where the token was allocated to sensibly enough users of their platform or users of their protocol. And specifically, it was weighted more towards users who were paying a higher percentage of interest on their borrows and similarly earning a higher percentage rate on their assets supplied. And as a result, in order to earn the maximum amount of comp, you would want to essentially pay the most amount of interest, which sounds backwards until you realize that the amount of comp earned more than compensates for the amount of interest paid. Additionally, you could kind of loop through or recycle through these assets by continuously borrowing and resupplying the same asset, with the limit being their collateral factor for that asset. So opportunists went in search of the asset on Compound that would pay the highest rate of interest, and these rates are determined by each asset's individual interest rate curve. So for example, if the USDC interest rate curve caps out at 15%, but the BAT interest rate curve caps out at 35%, then you would want to borrow as much BAT as possible instead of USDC. This opens up to, there's fairly little price risk involved because you're borrowing and resupplying the same asset more or less. But this does open up users to a bit of liquidity risk. And so we did see some distortions in the BAT market over the weekend. The BAT market blew up as a result of these incentives. And we saw, I think, as high as like 350 million BAT supplied versus 320 million BAT borrowed. Of course, a large portion of this was mostly recycled BAT. So it's a little bit hard to kind of quantify or reason about like the total amount of leverage that was embedded in the system. But nonetheless, there was a fair amount of, I wouldn't say pushback, but there's a fair amount of concern on kind of what the implications of this large BAT borrow market were, especially with the liquidity risk that I mentioned earlier. And so their governance community put forth a proposal to alter the allocation weighting scheme for comp farming. And so the new proposal, which was ratified 2 days ago, but is scheduled to actually execute on chain later tonight, works as follows. So instead of paying the largest amount of interest, an ideal farmer would want to borrow the most amount of dollars possible. So just the total borrow volume denominated in dollars. And so this changes the game theory a little bit, because now you no longer want to pay the highest amount of interest, but in fact, you want to pay the lowest amount of interest. So your comp rewards are diluted by as low amount as possible. So then you go in search of what are the lowest, which assets pay the least interest pays the least interest at the highest utilization rate, and that turns out to be DAI and USDC, and potentially ETH as well, depending on the utilization rate. So at this stage, it becomes a little bit confusing trying to figure out which asset is the ideal farming asset. There's a lot of kind of little nuances here, especially when it comes to evaluating the utilization rate. And basically, if you're recycling assets if you're recycling farming assets in an asset where there's an enormous amount of excess supply, then potentially it will dilute your comp yields. And so there's kind of this little debate on whether DAI or ETH or USDC will kind of will kind of dominate the farmers. So I think that's definitely a discussion worth having and definitely worth understanding. But at the same time, if there's even, I think the more important thing is that given that there's at least some non-negligible chance that DAI is the most ideal asset, this community should start working on mitigation schemes, what we want to do to kind of prepare for any market impacts. Over the past few days, there's been a dizzying number of proposals on the forums. So that should be interesting to carry out and explore. Okay, that's kind of enough for me as an overview. Does anybody have any immediate or initial questions regarding comp farming and kind of where we are today with Maker?
I have a question. So is DAI right now a better collateral for putting on compound because the USDC interest rate on Maker is lower than the interest rate on compound? I think that's the case, right?
Not necessarily. So increasing one of the ways to maybe disincentivize DAI is to increase Maker as a primary generator of DAI. So if the USDC rate were to go up, then well, we wouldn't have seen that large mint last night, right? But basically, for that person, it was cheaper to borrow that DAI from Maker than to just borrow it off of the Compound platform. However, that's really not at the core of why DAI is a popular farming asset. So okay, so here's how I think of, from a governance perspective, here's how I think about the whole situation. With the comp yields, we should think of it as there is a large external source of DSR for DAI holders. So imagine if some third-party service was just offering a very high DSR, then you could see a potential huge influx of demand for DAI. And then at the same time, the same third party is providing a source of very negative stability fees, which makes borrowing very attractive there. And to that end, we could see a potentially a large source. We could see a large refinancing activity from the Maker platform to Compound. That's, could be potentially dangerous if we see both large influx of demand to get into this external DSR, and refinancing from Maker to Compound requires sourcing DAI on the secondary market as well. So that's kind of where the primary demand concerns come in. So really, the question to governance could be, how would governance respond to such a rate environment? And so, well, very simply, if demand is going up, then you would want to increase supply. And so most of the solutions that have been put forth to governance on the forums over the past few days have been kind of variants of how do we increase DAI supply dramatically and maybe drastically in a short time. Kind of what's the safest way to do that? What's the most sensible way to do that? What concerns do we have, if any, on kind of increasing the amount of collateral in the system? For example, from a price standpoint, the easiest way to increase DAI is through USDC. So if the USDC were to expand significantly, then, well, maybe Maker could actually, maybe the large mint that we saw last night, and more to come if the debt ceiling were to go up, there's a really good chance that the community could turn this into a very positive outcome if they kind of tinker with the correct, if they find a right stability fee and a right debt ceiling. There's definitely an opportunity to both, keep the peg in line, expand the DAI supply, even though it'd be mostly USDC backed, and then also kind of generate a lot of DAI for the surplus buffer at the same time. I think that's probably been like at the forefront of the discussions, is some change to the USDC parameters. In addition to increasing the debt ceiling and the stability fee, a really common suggestion has been to decrease the liquidation ratio, which would allow basically smaller market makers to leverage up into even more DAI, putting further downward pressure on the peg. There's kind of this weird question of what happens if farmers mint DAI off of USDC from Maker and just stuff it into Compound instead of selling DAI like we would hope. And that's of course what we saw last night, right? 20 million DAI generated, and I think all went into Compound, right? Wasn't necessarily used to push the peg down. So this is where governance really needs to start to normalize significantly larger amounts of collateral and DAI supply in the system if they want to go down that route. So, if you could, if you're worried about centralization risk with USDC, and I think a reasonable assumption is that beyond some small threshold, say 30 million or 50 million, is probably already too much centralization risk to handle for Maker at this time, is just a hypothesis. Then there's really no difference between 100 million and 1 billion, right? And so just as a thought experiment, if Maker were to, if the amount of DAI that Maker needed to create to keep the peg in line and keep everything in check was 1 billion DAI off of USDC, would the community be for that or against that? Especially if there was a kind of a decent stability fee put in there for good measure. So I think that's definitely a very important question for governance to consider. Other supply-focused actions are a second ETH collateral type, so an ETH-B. Certainly there's going to be all sorts of kind of ETH-denominated market makers trying to get in on the farming activity, and that could kind of be both another source of supply generation and potential stability fee generation. We've also seen some kind of outside of the box ideas in the forums. I think MakerMan suggested some sort of a reserve type or open market type of operations, which would definitely be kind of a huge departure from what Maker has been doing up till now. But as I said, there's been quite a few different and diverse proposals out there, and unfortunately we are, we're time is a little bit of the essence. So as I said, that proposal goes live tonight. I don't expect anything to happen right at the turn of the clock, but certainly based on the activity we saw with BAT a few weeks ago, certainly I think over the next 3 or 4 days, our situation will become much more clear. Sorry, I'm going to stop talking, let other people jump in a bit.
Should I? Oh, sorry, go ahead, yeah.
I just wanted to say that, it's very hard to predict some of the longer term, or not really longer term, but, what will actually happen over the next few days. But there's also some shorter term things that are kind of more clear. So for example, already yesterday, someone took out 16 million DAI against 19 million USDC and maxing out the USDC-8 debt ceiling. So this has two important implications. Firstly, the USDC-8 collateral type is now exhausted, which is not good already, even before going into what might happen in the future, because that collateral type is there to relieve DAI supply a little bit, and now that's gone. So firstly, there's this direct problem of, should we try to address this? So should we try to, the obvious thing would be to increase the USDC-8 stability fee to the point where that sort of activity wasn't attractive. And the advantage of tackling that problem is also that we can actually look at the economics of that trade to understand what makes it attractive and what level of stability fee would make it unattractive. And the second the second thing is that this is potentially an example that we can look at to try to understand for what people might be doing later on with DAI and Compound. But I just thought that maybe it's worth discussing, starting the discussion with the USDCA angle, just because it's more it's at hand now, given what's actually already happened.
Can you briefly walk us through the mechanics of why the USDCA stability fee increase is helpful? Because I think I could easily argue that it's hurtful at the same time. So I just want to know kind of what the rationale there is.
Sure. So some of this is I'm speculating about the intentions of this trader, but so basically, like, we have to ask ourselves, why would someone put up USDC into a CDP, take out a bunch of DAI to put it into Compound? And I don't think the answer to that is necessarily straightforward, because you can't rule out reasons like being worried that in the future that debt ceiling might get exhausted, so they just kind of wanted to take it while they have the chance, there's this dynamic every time we're close to debt ceiling, someone might take out DAI just so that they have this option, because you can't force, well, we're unlikely to force close people's CDPs for going over the debt ceiling. So it could have been that. And then of course, parking it into compound isn't an unreasonable thing to do once you've got this position. And the interest rate is very low, so the cost of doing this is pretty low, all things considered. That's kind of the most sort of, I would say, the most naive option that doesn't really have anything that much to do with comp farming. This is quite unlikely because this user is a huge comp farmer, and this DAI went straight into compound, and they have a huge BAT recycling thing going on, which is actually the main source of income for this comp farm. So the second option is that for some reason there's superior economics there to putting USDC into Maker, then taking DAI, then putting into compound, instead of the more direct route of just putting USDC straight into compound and then doing this BAT recycling. And I think my guess for that is actually that currently these considerations aren't dominated by the actual interest rate, as in the actual, the stated interest rate on compound for DAI versus USDC, even though indeed the supply rate for DAI is a little bit higher than the one for USDC right now. I think the reason probably is the ratio of the total amount of USDC supplied to the total amount of DAI supplied in compound. So there's way more USDC supplied, which is not surprising because it's much easier to get that kind of liquidity to just dump into compound. Which means that on the comp yield side of things, you're making much more as a USDC supplier than a DAI supplier sorry, the other way around. You're making much more as a DAI supplier than a USDC supplier for the same amount. And I think that actually dominates the actual headline interest rate. I think, I mean, we can check this, but I believe so. So in that case, it's actually the fact that there's so much USDC supplied to compound that it's driving that decision to go into DAI instead via Maker. And then, I think the practical next step is to decide, is there a sensible level of stability fee that would make that trade no longer attractive? As in the user would just go to do the direct route of putting USDC into compound. And that would have the advantage of, taking all this DAI against USDC out, freeing up some debt ceiling so that, that debt ceiling can actually be used to ease, potential future demand shocks. Cyrus, does that answer your question?
Yeah. So so to sum up, have the stability fee high enough where it's still profitable for people who want to arb the peg, but maybe not profitable for people who want to do some other things with it that might waste our debt ceiling space.
That's what I'm thinking about. So for example, and I haven't checked the numbers on this, but if it turned out that a 10% stability fee for USDCA, if at that point this trade was this was no longer preferable to going directly into USDC and compound, then I would think that might be worthwhile, because the primary function of USDC as to meet demand is probably still going to be served at 10%, or rather, maybe it's going to be less effective at when DAI is at 1.01, but it's definitely going to be effective once DAI is at at 1.5 or something. So I think that would be like a comfortable middle ground where we would actually get our USDCA back as a tool.
Yeah, that's going to be, I think, too hard to forecast, because I think the distribution is going to change dramatically starting tomorrow. Because right now, most everything is in BAT, and we know that the annual yield is between around 70% annual yield, depending on the comp price. But I think with the new distribution, if we start to see, if it's split 2 ways or 3 ways, or who knows how much dilution there is within a particular asset, then I don't think there's any way we could know what kind of stability fee we would need to incentivize things one way or another, right?
Yeah, and also I agree. And also just to clarify, this trade right now that we were discussing, it actually makes sense given the current, pre-patch comp distribution, I believe.
Right.
So we don't even know if, as soon as this comp distribution goes live, I'm fairly certain this user is actually going to move some stuff around, because currently they have this huge recycled BAT farm, which is going to become suboptimal. So they're going to actually switch to another asset. Whether they actually keep DAI as their collateral base is also completely unclear. So there's also there's multiple phenomena here that we're discussing, right? So this one actually doesn't even have to do with this patch.
Right. Yeah, okay, that makes sense. Does anybody else have any thoughts or want to chime in?
Cyrus, I'll ask a potentially stupid question after all of Lev's feedback, which is that I'm not sure that I'm clear on why lowering the liquidation ratio, which seemed to be prior to this call the most popular option to do first. It sort of seemed to have a hierarchy of liquidation ratio, debt ceiling, then potentially stability fee, although maybe Lev's comments changed that. But if we haven't activated liquidations on USDC, and people can, in theory, go below 120% now without being liquidated, what effects does lowering that liquidation ratio actually have on the amount of DAI that people can get?
Right. So my preference is definitely debt ceiling first, especially because we know that at the current liquidation ratio, people are willing to take out DAI, as we saw last night. But the point of lowering the liquidation ratio is just to accelerate DAI generation, right? So if the liquidation ratio goes from 120 to, just as an extreme example, 101, 101, a market maker with 1 million USDC on hand can generate 100 million DAI of sell pressure, which is enormous, right? Now, of course, kind of the trick is that they take that 100 million and actually try to arbitrage the peg rather than just continue to comp farm with it. But yeah, the simple answer is that it just gets more DAI out there quicker with less collateral.
I would say that it's fairly straightforward to say that debt ceiling is important first, and then we can think about the liquidation ratio. Because, for example, when the debt ceiling is maxed out, it doesn't matter what the liquidation ratio is really. And just, I think in the grand scheme of things, debt ceiling is what will determine supply and rather than liquidation ratio, which is secondary.
So are polls going out today? Is that what's going to happen, or there's already polls?
No, so actually that's was going to be a topic I want to bring up towards the end, but we can just do it now. Is basically, does the maker community want to wait and see what happens? 24 hours, a day, 2 days, right? Like, I think one could definitely argue that doing anything preemptively could be, right? It could be smart and kind of ahead of the game, or it could also be kind of rash and just, if we put out a poll that increased the USDC debt ceiling to 100 million today, it would, maybe be a bit rushed, but it's definitely an open question. And additionally, over the next few days, depending on how things turn out, I would say there's certainly some it might be worth it to consider skipping governance polls as well if we need to, basically ad hoc or pseudo emergency executive votes, especially given kind of just the poll turnaround time and the GSM and yeah.
And the holiday coming up too. It's kind of
right.
No one can, there could be a lot of people not at their computers when you need it.
Right. So coordination is definitely going to be a huge challenge over the next 4 or 5 days.
I would say that the most important one days would be to discuss what actual steps should be taken, because I expect a lot of assets in Compound will get shuffled around after the patch activates, which would make some of the possible calculations incorrect.
One thought, if I may, on the stability fee. If the stability fee on DAI is increased, but the demand for DAI for people to put into Compound kind of stays the same. It basically transfers the pressure from people who are minting DAI to people buying DAI on the open market, and probably pushes up the DAI price kind of pretty significantly, or potentially significantly as well, if people can't make more DAI and kind of relieve that pressure.
Yep, that's a good point. I mean, classically, when you increase the stability fee, that's typically what we use to push the DAI price back up. And really what we want to focus on, I think what we want to focus is on doing whatever we can to increase supply. So yeah, that's definitely a good point.
Should I maybe talk briefly about like the governance, kind of like the ways we could kind of go forward with this governance-wise then?
Please.
Since that came up. Yeah, sure. Cool. So obviously we've had like emergency polls and votes before, so that's fine. But in order to sort of be kind of comfortable doing those outside of the weekly cycle, we either need, well, like as a governance facilitator, I would want either like a clear forum poll saying, you know, sort of asking, does the community think that we should take emergency action to fix this, like outside of the regular cycle? Again, like ideally with sort of a clear idea of what we want to do as an emergency action. So we'd either want that, or I would either want that. Or the alternative is if Cyrus, as the risk domain team, thinks that we should take emergency action, then I think that makes sense to do, right? So yes, I guess based on whether, I mean, yeah, again, it depends what everyone thinks, right? If you think we should act now, then we can potentially do that if one of those things is true. Alternatively, we can wait and do some polls on, put some polls in on Monday, and then make some actions on Friday next week. Or we can kind of just wait, and if things get like, you know, obviously worse in the next few days, then we can do emergency actions at a later date. So before Friday, but after today or tomorrow. Is that kind of clear to everyone what they would need to do if they want things to happen, I guess?
So when is does anyone know specifically when the new patch is going to be updated to Compound? That's happening tonight, right?
I believe so, yeah.
I believe it's 2 hours 15, but I could be wrong. I might be getting screwed by time zones.
I mean, is it like, are people going to be paying attention like on July 4th and tomorrow? Like, can we like, presumably, could we like have another like governance meeting, like potentially, like if things just look, because I do agree that it's probably, it's good not to like overreact about something that could just be nothing, but we should at least have like kind of somewhat of a plan, like to at least work over the weekend where the market could be moving really fast and a lot of people could just be kind of away, you know what I mean?
Yeah, I mean, we can definitely do like emergency governance meetings, like we have in the past, right?
Cool.
Again, that would be the sort of thing where, you know, either Cyrus says, okay, I think we need to do something like as an emergency, or the community votes and there's a consensus for we need to do something immediately.
Yeah, for what it's worth, I think I'll be around to, I'll be monitoring this for sure.
Yeah, likewise, I'll like keeping track of what's going on. So.
I mean, just a small point from me, you know, I would be happy to see potentially, you know, in line with Lev's points that the USDCA debt ceiling is already maxed out. You know, it might be potentially a good idea to get a little bit of it ahead of that. And the reason that I say that is because I kind of, you know, Cyrus, while I agree with you in principle that if we've decided that, you know, the centralization risk that we face with USDC is sitting between, say, for instance, 30 to 50 million, then there's in principle no difference between 100 million and a 1 billion debt ceiling. But I think that in practice there is a difference, and it has to do with the fact that governance is largely about optics. This community is seen as doing anything and everything it can to defend the peg. So like a preemptive small raise in the USDCA debt ceiling might not be a bad thing to sort of poll for, at least in the forums now after the call, just as sort of proof that this is something that we're carefully watching and considering for a wider community outside of the people that are just on this call.
Yeah, I think that's a very, very valid point. So I would suggest that after the call, we put out a signal request for, because at this point I'm not even clear what specifically we want to be polling for and what types of options we want to put on the table. So that would be something that I would love to get some clarity on, either on this call or afterwards in the forums, and then we can start working on a governance poll.
Yeah, I think I would, basically what I observed, I think it would be good to get to have a better idea of what our options are, I think, like options that might help or things we could do in various situations, which might be good to try and figure out in advance, right?
Well, I think like immediately, right, we all agreed that there's somewhat of an issue with the USDC vaults, USDC-A vaults. So maybe we just try to kick off a poll with some parameters around making changes to that, raising the debt ceiling, increasing stability fees, and then taking it from there. That seems like, and that's like the type of action that like we're very kind of comfortable doing, I guess is the best, like we have a lot of like history, changing stability fees and lowering and raising debt ceilings for ETH, and other things. So seems very natural, I guess is what I'm saying.
Cool, thank you. Did anybody else have any thoughts on potential governance actions? Lev, would love to hear from you as well.
I would say that I would actually probably lean against preemptively increasing debt ceiling without changing the stability fee, just because if we increase debt ceiling and that immediately gets eaten up by maybe even the same trader for the same trade, because we didn't figure out at what stability fee it actually breaks even, then it would be a waste, and we wouldn't have achieved much. On the other hand, if we are increasing the stability fee, then it could be appropriate also to increase debt ceiling. But it seems like just feeding this trade, which probably exists. I'm assuming that this behavior isn't irrational. Just feeding this trade without, which we know is just eating up the debt ceiling, and that DAI is ending up getting locked in compound. It doesn't help.
But don't you risk raising the stability fee high enough such that it's no longer profitable to do the intended function, which is arb the peg down? Don't you almost need to keep it low enough until all the excess demand from compound is diluted away, and then they start arbing the peg? Do you get what I'm saying? Like,
I agree. I agree that we're trading off. So I would definitely agree that setting it too high would be counterproductive. But you have to firstly keep in mind that most of the debt ceiling currently is actually used on this comp trade, which means that by clearing that up, you kind of get more room than you do from potentially, scaring the remaining part of it, which is sort of, so-called legitimate. And secondly, I think that it's only acceptable to raise the debt ceiling if we come to the conclusion that a good number there will be somewhere in the kind of, let's say 3 to 13% range or something, where you could definitely imagine people still using that for peg arb at like, DAI price at 1.01 to 1 point, and higher. I think just heuristically that seems reasonable, and that basically we're in a much worse situation if we don't have any USDC rope at all, because then imagine there's some other exogenous event right now, like ETH getting bearish. We have no rope at all in the USDC debt ceiling. It's not a good situation to be in. Like if DAI starts to go to 1.05 and higher, we have very few mitigations until we start getting into the range of where USDCB is economical, which will be quite far off.
Okay, so what about a signal request for debt ceiling and a signal request for stability fee? Maybe we put those out today, and then we put out a governance poll maybe tomorrow, so that people have maybe a chance to kind of see what happens during the course of today, and we can take it from there. Or LongForWisdom, does that jive with your?
Yeah, again, if you think that's warranted, I think that's fine. One thing I would say is to, if you want to make sure that they both happen or they don't happen separately, then you would probably want to make them a combined poll, because you have kind of a problem if like the debt ceiling one passes, but then the stability fee one doesn't pass, but you actually, the people who voted for the debt ceiling only wanted it with the stability fee, and it gets a bit messy. So just, yeah, I guess I would suggest like a set of like combined rate parameters, including debt ceiling and stability fee.
Okay, makes sense. Maybe we can jump into state of the peg now, so we kind of get a sense of where things are at right now, and then maybe just do wrap up and Q&A afterwards.
Sure. All right.
Rich,
can I give
Vishesh first?
Yeah.
You should be good now.
All right. Can you hear me all right?
Yes,
Yeah, you sound good.
Okay. All right. So first thing is the peg. So just to kind of put things in perspective, if you have trouble hearing anything or seeing anything, just interrupt me. To put things into perspective, the DAI peg in the last, I would say 48 hours, has come up a bit. I think nobody's really surprised at that. A couple of things going on. Obviously, on the one hand, we have some of the compound activity, and on the other hand, we have ETH prices looking relatively cherry. So just the combination of both of those things, I think, creates a little bit of a liquidity crunch on DAI. Good news is, prior to this, shift in some of the secondary lending interest rate models for DAI, there was a fair amount of buffer just in the amount of supply that was available to borrow. And so, from that perspective, the impact on the liquidity crunch of this was initially mitigated a bit, but I do think that that's going to continue to have a potential price impact. So you shouldn't be surprised to see, DAI prices at $1, $1, $2. There's not always a guarantee as to the impact on price from secondary lending markets, because very often it's a circular relationship. But in this particular case, given that there's such a rapid use case for DAI on secondary lending markets, and given the fact that there's, as Cyrus had touched on, something I shared last week was basically a way to reason about what the impact of comp farming has on a particular underlying asset is to have effectively an elevated supply rate and a extremely depressed borrow rate, because both sides are effectively compensated for by the underlying yield token, which in this case is compound. So what that means basically is, and we've seen this situation a long time ago in a very different context, when you have a very low borrow rate and a very high supply rate, it sort of incentivizes that rapid refinancing and secondary market rewrapping, and basically pursuing a large degree of leverage very quickly. but in the past, you know, we'd seen that that yield for those rates doesn't necessarily last very long, goes away quickly, and then interest kind of jumps back down. So that's the scenario that I think you want to try to consider and manage against. So for the peg here, I think that that price could potentially continue to go up. So that's just something to be weary of. To put this in a little bit of context as to what's going on behind the scenes, so total DAI is at 146 million. DAI from ETH, however, is still just around 114 million. So what we've seen basically is, and DAI from BAT has shrunk. So I'll actually go into each one individually. So here's the ETH DAI supply. Basically was continuing to rise, a few dips and spikes, again, due to compound. And then we see here basically in the last 48 hours, just like flat. So this makes a lot of sense if you consider it. There are a lot of things you can be doing with your capital right now. It's not necessarily the most attractive to just take ETH and quite simply dump it into Maker and mint DAI. There are other things that people are doing with their capital at the moment, and that's something to consider. And I'll go into the collateral in a moment. But you can see here WBTC, so this is just continued to sort of stay level ground maxed out. USDCB, there were a few that were used, but it's really not been used right now. KMC, you know, again, small amount has been used because it's a new thing, I think primarily. And then BAT. So BAT, basically what we saw, you know, the impact of March, and then was continuing to rise. And then basically in the last couple of weeks, the remaining amount of USDC borrowed had shrunk. And that's kind of what's going to be the impact of some of these yields on Maker assets, right? Because if you basically put this in perspective of what happened after March, that supply, that DAI supply minted from BAT was rising and rising and rising. And then basically once there was a more attractive yield of what you can do with your BAT, basically refinanced away. You know, you lost basically a majority of the percentage of DAI supply minted from BAT. So now we sort of come to USDC and we look, the utilization of this has been sporadic but lower since May, basically. And now all of a sudden, you know, in the last 24 hours, this just completely maxed out utilization. And again, we're not necessarily surprised at that, right? So if we look at some of these compound markets, BAT we talked about, I mean, and again, you know, sorry, this is going to be kind of dominated by compound, but that is a large topic of what's going on right now. So what we saw basically was BAT became kind of this important asset for comp farming, and then there was better yield opportunities for what you could do with your BAT, and so that was kind of that supply shrank. ETH will kind of save that and go back to it, but basically the amount of DAI minted from ETH is also slowed. It's just kind of steady, and the collateral amounts of ETH have reduced. So that's something to talk about. But USDC, we saw, you know, basically a large amount of USDC has been supplied, and an even greater amount has been borrowed on a percentage basis, but pretty comparable numbers from a nominal value in compound. And so,
Vishesh, can I jump in for a quick second?
Yeah.
Because there's just something I want to highlight on this page that's really important. So it's definitely not a foregone conclusion that DAI will be kind of the highest utilized asset for comp farming. So what we want to focus on here is kind of the oversupply of ETH and the oversupply of USDC. So right now, ETH is 242 million versus 3 million, and USDC is 227 million versus 34 million. So both the gross borrow for ETH is up 500%. Basically, a few days ago it was just like 500-600 grand, and the USDC gross borrow is up 21%. If those numbers continue to increase, if all of that ETH supply that's sitting there starts to become just borrowed by its owners, reducing that spread, then that would be definitely very beneficial for us. That's almost like the rational course of events over the long run. So this kind of goes back to Lev's forum post from yesterday. The issue is, though, for whatever reason, those large ETH suppliers just don't start borrowing their own ETH, then it's kind of in that situation where the impact might come back to DAI.
Yeah, so there's two important stats to mention there. One is, so you can just see the amount of excess supply for ETH, huge. The other thing is to consider DAI. I mean, as far as I understand, the attractiveness of the rates is, I think, the name of the game here. Now, basically, whatever has the most attractive yield is where I think interest moves to. In this particular market, this particular scenario, I think that's going to be the case. And so a huge part of this is to consider how the attractiveness of the yield is determined. And I do think a portion of that has to do with, you know, what share that particular borrowing market has of both the total assets supply and in terms of the total open interest on Compound. And so there's a sort of a separate point to be touched on. It could be its whole own conversation, actually, around the different nuances of the attractiveness of the rates of each of these assets on Compound. But yeah, it's definitely an important point to consider that the expected utilization of DAI here is hugely dependent on just the attractiveness of those rates. So if those rates are not as attractive as, say, you know, borrowing your own ETH on Compound, then you can definitely see, you know, a scenario where a lot of that interest shifts to a different asset. And I think that was sort of exemplified with BAT, right? You know, as the attractiveness of that yield shifts, so too does the interest. And I think it's potentially going to be a continually moving target. We'd have to wait and see. But sorry, so to just kind of complete the thought around the secondary lending markets. So, you know, for USDC, we saw basically a large chunk that was both supplied and borrowed in terms of USDC on Compound. And we saw basically recently a large amount of USDC minted from DAI from Maker. And I think that's potentially a trend that you can expect to continue to see as well, given the attractiveness of the rates on Maker for minting USDC. And there's a lot of, I think, risk-oriented math that goes into, given the fact that that's a low collateral requirement, and given the fact that it's a relatively safe or stable trade, at least as people are considering it, that it's going to be a potentially very attractive option. So that's an important conversation around what kind of debt ceiling you want to manage for USDC. And then, you know, Cyrus already mentioned it, but not to state the obvious, that a decent amount of DAI has been both supplied and borrowed on Compound. And so it's important to keep an eye on the fact that from a risk perspective, right? So we're talking sort of about behaviors, peg, supply, demand, et cetera. On the other side, just what is the underlying risk that's being created from these behaviors? You have 61 million DAI out of, you know, 140 million that is sitting as supply on Compound. That's a large chunk. And the larger that chunk is of the total DAI supply, I think the larger part of the conversation of what is the total risk of the system for Maker that particular application is, and I think that share is large and potentially can grow further. So it's an important part of the conversation, undeniably. So just to come back to some of these collateral assets. Sorry, I'm running so many scripts. My computer's going to complain a bit. So that was the USDC DAI supply. To touch on collateral real quick. So for ETH, though we didn't see a large movement in the amount of DAI minted from ETH, there has been some movement in the amount of collateral. In that currently, it is a fairly attractive option. You can see from the relative supply rates on Compound to be supplying ETH on Compound. Now, that I think changes the mental calculus for certain users around how much ETH to just leave sitting in Maker. And though they're not necessarily ready to make huge changes in the amount of DAI that they've minted from that ETH, I think there have been some shifts in individual users in the amount of ETH that they leave sitting as excess collateral versus potentially, supplying that on Compound or, chasing other yields with it. And I think that has had a small to moderate impact on the amount of ETH supplied as collateral on Maker. And so we've seen basically this 200 to 250 and 250 to 300% collateralization buckets grow. 300 to 350 bucket, has relatively shrunk, and then the 500 plus bucket is also relatively shrunk. So I think this has gone from being a primarily trimodal graph to being bimodal or primarily dominated by this 200 to 350% collateral range. And I think it's very clear why. So touch on some of the other assets, USDC. So basically, if we look at some of the largest USDC positions on Maker, they're, you got the biggest one at roughly 16 million at like 120% collateralization. Again, given the nature of this particular vault type, you don't need to have a lot of collateral for the amount to borrow. And this has been the conversation with USDC since it was added. Basically, nobody's expecting a large amount of price volatility risk there, but there are always these risks about USDC that just need to be continually kept aware of as this collateral type becomes more and more prominent, by the month. I think it's just important to note that that is a non-negligible share of the total amount of DAI that exists. And that's I think something to continue to keep as part of the conversation around this collateral bucket is just what are the risks that you continue to assume as it grows. And if we look at sort of the nature, again, on Compound, what's happened recently, if we saw in the last 7 days, obviously there was a large amount of BAT that was originated on Compound, but in the last 24 hours, you've seen a creeping share of that be DAI interest and USDC interest. So, this is something to keep an eye on. WPTC, I think, is a slightly different conversation. That's something that, I'm sure people may or may not want to double click on, but for the moment, just focusing on USDC and DAI, that those, as a total percentage share, those have grown. But I think that's particularly clear, and I think people understand that. Yeah, so I will sort of pause there. I'm sure that was a lot of info, and if there's specific things that people want to double click on, we can. I'm just going through a chat, so a lot of comments. I don't think there's any questions. I'm sure Rich will allow an awkward silence to persist.
Sorry, it's my job now. I'll deal with the silences. So we're past the hour now. So Q&A session is officially on. If anyone has questions about anything.
Yeah, I have a question for everyone. I don't know if you guys can hear me.
Yep.
So it seems like from the comments, like DAI is right now the most attractive because of the difference between the borrow rate and the deposit rate. There is currently a DAI interest model vote going on Compound that is pretty contentious. It's the first time I've seen like not 100% go one way. So does anybody have any opinions of first the vote going on Compound and how it'll affect DAI? That's the first question. The second question is, if the interest rate difference on Compound was larger than, let's say, USDC, between the borrow rate and the deposit rate, wouldn't that solve our problem of why DAI is going to Compound? Because of the recycling effect? I'm hoping everyone understands my questions.
Akash, just one thing to comment on what you said is that I'm not actually convinced that post-patch, the spreads between the displayed supply and borrow interest rates are actually the dominant factor, and it's because post-patch the interest rate per se doesn't go into the comp yield calculation anymore like it does now. So the interest rate is an additional cost that you have to pay on your comp farm. But the comp yields themselves are just like huge. So unless you're really paying a lot of interest, and generally when you're recycling, you're making back most of what you're paying on the borrow in your supply. So just keep in mind that basically, it's just from numbers that I've looked at, you end up getting something like 80% APY comp yield, obviously at current prices, et cetera, while paying 5% APY on the actual spread between the supply and borrow. As in, essentially, the supply and borrow spread ends up being less important. And what dominates the comp yield is the relative share of the lending and borrowing on that market, which can be a much bigger difference between different assets. So I just wanted to point out that to keep this in mind.
Right. I mean, another question that's kind of also unrelated, I don't know if anybody has done any research, which is, of the guys that are recycling on Compound, are they completing the arbitrage by selling the comp token, or is this a way for them to accumulate comp tokens? Because that would help some of the understanding also of what is driving this. Does anybody know that?
I don't think people are I don't think people are speculating too much on the price of comp, to be honest. I think that just kind of adds an additional variable to the kind of the overall business model. Sure, some are because they have opinions, but I don't think it's like a core part of the entire operation.
Okay.
Of course, the entire concept of comp farming has blown up because of the sustained high prices. That's definitely true.
When do you think the music stops? It's gotta happen eventually. Very basic question that I have is, I only have like a tenuous grasp of really like what's going on with this farming, but where exactly does this subsidy come from?
It comes from retail speculators putting up bids on the secondary exchanges. They're ultimately the ones that are, the amount of collateral that is flowing to Compound is a result of the dollar
Sustained
amount of
comp
comp
price.
you can get out of it based on that collateral.
Yeah, I mean,
Very bizarre.
let's just discuss the arbitrage fairly cleanly, right? Like you deposit funds on Compound to earn comp tokens to sell comp tokens to complete the arbitrage, right? So
Not really
whoever's
arbitrage, but it's just like a subsidy, or it's like a rebate. So, you know, decentralized liquidity rebates, and the rebates are very high.
yeah, I guess the true arbitrage would be if you can borrow USD in the real world for, let's say, 10%, and
Sure.
essentially get a 20% return
Sure.
in the DeFi world.
Oh, I just thought I'd mention an idea for like a nuclear option if the situation gets really is really out of control. In principle, like MakerDAO can do a kind of open market operation where it mints a large amount of DAI, puts it into Compound as supply, and then takes the C DAI essentially as collateral onto its balance sheet. And by doing this, you can essentially flood Compound with an arbitrarily large amount of DAI. It could be like 1 trillion DAI or something, and essentially have all the C DAI on your balance sheet instead, and then that will essentially wash out everyone's comp yield. So firstly, it would make the size of the DAI of the supply side of the DAI market so big that no one's going to be making any money on the supply side. So at that point, I think that could really tip the scales in favor of literally any other asset. And it will also mean that essentially, Maker would actually be collecting the comp for the DAI part. So essentially, there would just be no way of making money involving DAI on Compound anymore. It would all just be collected by MakerDAO. So it's just worth thinking about that possibility. And it's safe because essentially we're taking it's kind of safe because we're taking the CI onto our balance sheet as collateral. So we're kind of collateralized by the other Compound assets.
You can achieve something similar without the social implications, right? I mean, if the liquidation ratio goes low enough, like I think at 101, I think at 100x leverage, that would just be incentivizing the market makers to do this pretty much the same thing, right?
Yeah, I just like the component where we can take the C DAI on our balance sheet to avoid taking additional risk. I mean, it's worth thinking about. Like, obviously, if you flood the DAI supply too much and then it actually leaves Compound, then you have too much supply. But I think the difference between what I suggested and what you suggested is that we can actually take the C DAI as collateral at like 1-to-1, basically. It's literally QE for DAI.
Right. Yep.
And sorry, if you were to do this, what's the interest rate for the C DAI?
It's so this isn't a CDP at all. This is an open market operation where the MakerDAO itself mints unbacked DAI. Well, it's going to be backed by the C DAI that we get in return, essentially. So MakerDAO itself acts as like an agent to put a large amount of DAI into Compound. And the reason it's not completely whack is because we're actually getting C DAI in return. Just like when you do QE, it's not completely whack because you're getting like bonds in return. So we can unwind this later, basically by giving the C DAI back to Compound in exchange for the DAI.
If we did that, we'd get like a huge amount of comp though, because the open borrow on the DAI market would be like 1 trillion, right? So like we essentially just take all the comp then, which is not a great look.
Well, yeah, that's why I said nuclear option, and also just the sort of situation where if it's kind of adversarial or drastic, where this seems warranted. I mean, I don't love this idea myself, but I'm just saying that it is out there as an escape hatch.
Cool.
And also, just before anyone like makes fun of this, like it doesn't literally need to be 1 trillion DAI, because that for many reasons that would just throw things off too much. But it can just be a sizable amount that we thought it would have the necessary effect.
Okay, so let me kind of ask the reverse question. Lev, like what would you propose in an ideal world that the comp governance does to, I guess, mitigate risk for the MakerDAO system?
I think we need to basically post-patch, we need to figure out whether or not it's actually the case that DAI is getting sucked up, and if so, what parameter makes that trade attractive? Like, what's so special about DAI? Because some have suggested it's it's the interest rate curve, which I think is valid because DAI is essentially this freak asset on Compound that has this absurdly low interest rate curve. I mean, you can think of yourself why they decided to do that, but it's a little bit weird. So all the other assets have this kind of linear curve, and the DAI one is essentially flat and also pegged to the ETH stability fee. But I think that might not even be the main reason initially. It might be actually a little more to do with the relative sizes of the supply.
Well, I mean, again, I'm just playing positive advocate. I think they might have done that to help the MakerDAO system when the peg was off, and you could easily borrow DAI from there at lower rates to hopefully maintain the peg, right?
Yeah, so sorry, I didn't mean to speculate about the intentions there, but I'm just saying that has the effect that it can be abnormally cheap to borrow DAI on Compound.
Yep.
So sorry, just to give a succinct answer to your question, I think if it's the rates, if it's the rate curve, then they need to change the curve. If it's actually if it's a question of relative supply because the comp yield dominates, then comp supply scheme I would recommend be patched again in order to not put this absurd pressure on the smallest market, which is kind of what it's doing.
Yeah, I kind of feel we'll just find out a lot more tomorrow.
Wait, so is the interest rate for the interest rate curve for DAI on Compound that's set via the FA stability fee?
Yes.
It's a somewhat complicated formula. You can see what it is at any point in time. Just on the front end, you can actually see this curve and just scroll on it. But if you want to actually work out how it depends on the stability fee, you need to look at the code. I looked at it this morning. It's like I couldn't describe in one sentence what it is, but basically it is in some sense pegged to the FA stability fee.
So if we up the FA stability fee, we can increase the interest rate on Compound?
Exactly. We would be increasing both the supply and the borrow rates, though.
Right, but we could, I don't know how feasible this is, but we could set up an FB, move people over to that one. In the time frame, it's probably not reasonable, but just as another sort of crazy option, and then up the FA stability fee to whatever we want to make it unattractive.
Yeah, I think I've also thought about. I think that's also like one of these backdoor hacks that might work, especially in the extreme. It's not even inherently obvious that if you just manage to jack up Compound supply borrow versus using the stability fee as a backdoor, that you would actually make the situation better, because you might also just incentivize a bunch of supply into it, if you see what I mean. Because like imagine we have this ETH-B, which is very cheap, and we trick Compound into making their supply and borrow rate for DAI really high, then we might just end up incentivizing more of it getting sucked in. So it seems like a double-edged. I mean, they also have the right to upgrade their interest rate model again, so that they don't have this backdoor as well. So it's a little bit adversarial, obviously.
Right, so we're coming up on 25 past. Probably got time for one more question if there's anything else, but we'll try to finish at like past, I think.
So just to confirm, after the call today, I'm going to put up signal requests for USDC stability fee and a conditional, or USDC debt ceiling and a conditional stability fee.
Yep, that was my understanding.
Sorry, this is kind of a random question. When does the other debt ceilings increase, and like when does that go into effect?
You mean like the wrap
WBTC one?
Bitcoin one?
Yeah, exactly.
I guess along with the executive vote.
Yeah,
But it's
and
24 hours after, right, or something like that.
the GSM is currently set to 12 hours. So the executive goes live on Friday at the usual time. Some time passes until it gets to enough maker, and then there's 12 hours on top of that for the GSM. All right. Unless anyone has a last burning question, I think we'll leave it there for today. So, all right. Thank you everyone for coming. Feel free to go about your business. I think we'll end it here. Rich, do you want to stop the recording?
I want to enjoy. Feel free to go about your business for a little longer. Nice. Thank you all for wisdom for moderating. It was well done. I appreciate it. All right. Thanks, everybody.
Good call. Thanks, guys.